You're losing $20,000 a year in tax deductions as a high-earning dentist, and the IRS won't tell you why. If you're pulling in $250,000 or more drilling teeth, there's a silent tax leak draining your bank account every single April. The alternative minimum tax is quietly clawing back $15,000 to $30,000 of the deductions you thought were locked in. That's a down payment on a lake house. Gone. By the end of the next 4 minutes, you'll know exactly which 3 tax traps are hitting dentists earning $200K plus, the specific dollar amounts each one costs, and the 2 deductions that can claw back $5,000 to $7,000 before next quarter's estimated payment is due. No fluff, just the numbers your CPA probably hasn't shown you. Let's start with the big one, the alternative minimum tax. According to the IRS, high-earning dentists often get pulled into AMT territory, which limits your ability to deduct certain business expenses. The result: a gap between the tax savings you expected and what you actually owe, usually $10,000 to $20,000. Imagine writing a check for a new chair expecting a deduction and the IRS quietly says nope. But here's the worst part, it's not just the AMT. The passive activity loss rules can wreck you too. Say you bought a rental property to diversify away from your practice. Smart move, right? Except the IRS may classify those losses as passive and block you from deducting them against your dental income. That's another $5,000 to $10,000 added to your tax bill. So why is this hitting dentists harder than other professionals? Because of the income curve. According to BLS data, the median dentist earns $156,240. But the top 10% pull more than $208,000, and practice owners often clear $300,000 or more. That income lands you in a tax bracket where deductions get phased out, credits disappear, and AMT kicks in hard. You're earning like a CEO but getting taxed like one without the CEO's tax team. Now here's where you fight back. The home office deduction, if you handle billing, charting, or continuing education from a dedicated room at home, can save you $2,000 to $5,000 a year. Most dentists skip it because they think audit risk is high. It's not if the space is exclusive and regular. Document it with photos and square footage and it's bulletproof. Pair that with the lifetime learning credit for continuing education courses and you're stacking real money. But wait, here's the trap nobody talks about, your retirement accounts. You've been told to max out your 401k and maybe a cash balance plan. Good advice in your 40s, dangerous in your 60s. Why? Required minimum distributions. Once you hit 73, the IRS forces you to pull money out of those accounts whether you need it or not. A dentist with $3 million in a 401k could be forced to withdraw $113,000 in year 1, taxed as ordinary income, potentially at 32% or higher. That's $36,000 to the IRS in a single year just from RMDs. The fix: start Roth conversions in your lower income years. The gap between selling your practice and turning 73 is golden. Convert $50,000 to $100,000 a year at the 24% bracket and you'll save 6 figures over your retirement. There's also the practice sale itself. If you sell for $2 million and structure it wrong, you could owe $300,000 in federal tax alone. Structure it as an asset sale with goodwill allocated correctly, and you can shave $50,000 to $80,000 off that bill. This is the conversation to have with a CPA who specializes in dental practices, not a generalist. Quick recap of what you just learned. Trap 1, the AMT is costing you $10,000 to $20,000. Trap 2, passive loss rules are blocking $5,000 to $10,000 in real estate deductions. Trap 3, RMDs in retirement could cost you 6 figures if you don't start Roth conversions now. And the fixes: home office deduction, lifetime learning credit, Roth conversions, and proper practice sales structuring can put $20,000 or more back in your pocket every year. If you want the full numbers and the implementation checklist, the deep version is in my book Top 1% Net Worth, link in the description. A dentist who reclaims $20,000 a year in taxes and invested at 7% adds roughly $100,000 to $200,000 over a career. That's not a rounding error. That's a second home, a kid's college, or an earlier retirement. If this saved you money or opened your eyes, hit subscribe. I'm covering the $50,000 investment trap in the next video, dropping next Wednesday. Ring the bell so you don't miss it. What's your biggest takeaway? Numbers do not lie, listen to them.